Many AI startups struggle to find any consistent revenue stream at all beyond the tech-crazed venture capitalist, and a not insignificant number have been caught misleading investors about the AI's capabilities to keep the cash flowing.
I talked to a VC yesterday, and we were guesstimating, because of the sheer number of AI companies that have raised capital, if you just did it on a company basis, I'm thinking 90% to 95%. There's going to be some tremendous outliers, but just go to zero.
The amount of pitch decks that all of a sudden have the word AI on the front page, yeah, that has changed tremendously. And it almost filters a lot of companies easily out for me, not because I want to be, whatever, a dick about it, but it tells me that it's a signal that you haven't been thoughtful about the non-obvious part of your business.
Bricks, bucks, and bytes.
Welcome back. Last week we had a little break, so welcome back to Bricks, Bucks, and Bytes. How was everybody's week off? Did everyone have a week off, or were people working, or were people... Actually, Dustin, I think I know what you were doing.
That's right. I was at a conference and on my feet for 3 days, talking more than I've ever talked at a conference. Mentally exhausted, but it was great.
What did you talk about?
Edify and pre-construction and AI and where technology is going and everything under the sun. I had a lot of conversations that just, went down rabbit holes with both founders and then just customers. And
Well, that's surprising if there was something from this conference about pre-construction. Surprising. They surprised you.
You could open up a can of worms here.
I think the most surprising thing actually still is like how many software applications are still going to conferences, even though they're like zombie companies. Some of them are owned by large companies, but it's like this tech stack that's never going to be developed on again. And they're just trying to
So all the infrastructure.
It's like these old desktop applications and they're just trying to squeeze every drop of water out of this dry rock.
Well, I think that means something, right? That means that there's not enough good competition and they still have place to be.
Yeah.
I just, I actually understand from the ownership perspective why they do that. I just struggle, who wants to work for a company like that? And they find people. I always hope, I hope for anyone you find a company that, can offer you more than some of these companies can.
Mm-hmm. Hot one.
Take any conferences on your end?
Yes. 5 in a row. Because I love the experience. Yes.
You like the exposure.
Man, come on. You know me better than that.
Hey,
man.
where did he get his new jacket from? He must have been out somewhere shopping.
That's
Is that suede?
This is the label from Jensen Wang.
Must be a high-end designer. I don't know of.
Yeah, the black was sold, so I had to go with brown.
You could be starting something here. Every time we see you now, we expect to see this.
I'm taking a page out of his and Steve Jobs' playbook. Yes. Just,
hey, Martin, how is the east coast of the US?
Very good.
And
very good.
You can say what you said before. You said you would say it in front of Patrick too.
Well, I won't be too controversial if I say that I'm in the greatest country on the planet.
Sorry, someone with a pistol there, or
Fact check true?
No, I just like the US. It's a great place to be.
Very good.
Yeah.
Well, anyway, okay. Shall we?
By the way, dear listeners, this is how you get a cross-border control at the airport, by saying what Martin just said.
He's well rehearsed. Martin had a experience on in crossing the border from Poland to Belarus, so he's very well versed in how to cross. Do we say the US border is controversial? I don't know.
That was very smooth for me. The Belarus one was very, very stressful and sweaty for me.
What was this incident?
In Belarus?
Yeah.
Oh, I just was interrogated for like 20 something minutes. Checked YouTube, checked Instagram, everything, and yeah. So for like 2 meter tall, bald, and quite chunky man, one in the room.
Was
Like,
there a cavity search involved?
yeah, there was not.
I believe you.
So Martin can now say in 19 different languages, I'm in the greatest country on the planet.
I have 3 at least.
He doesn't learn higher hello first.
At least
That
3.
one phrase.
Oh, man. Okay. What are we speaking about today? I'll let you guys guess the first subject because I think it's a tough one.
AI?
Well, how did you guess? Man,
Let's talk
How many
business.
people talk about these days?
you look like you've been reading the notes for today, Dustin. I'm glad someone has. Okay, so it looks like there's been some interesting things happening in the world of, as usual. I'm not saying anything new here, but particularly on the, let's say, adverse side of AI, I think triggered by the collapse of Builder AI, which was definitely happened within the last week or so, and also some. I don't know if this is positive, but perhaps more interesting news, whereby OpenAI have acquired Johnny Ive's IO company, and we will dive into what perhaps that means for people in the AEC space. Then we'll move into business building. So we haven't actually done a segment of business building on here, but kind of makes sense when we've got Dustin here to give us a lowdown. And we're going to be diving into hiring, and we also broke down some of the best bits that we had collected from interviews that we've done on Bricks and Bytes over the years. We have some funding news, and finally, we will jump into what the true TAM of the AEC industry is.
12 trillion.
And we lost margin.
And mine's like, I am not partaking in this
No more
conversation. Hey, he just said the US was the greatest country in the world. It looks like the connection has some kind of issue.
It caught up
I
with
thought before he got on, he said New Jersey was the greatest place on earth. I was like, I don't think anyone's ever said that before.
Oh man.
All right, let's go into this. So a few things. Oh, he's back. Hey, Martin, I'm glad you didn't hear what we just said. Anyway,
What was that? About cavities again, or what?
Specifically yours, yes.
Yeah. Okay, so a few things that had triggered this discussion that we're going to have today, specifically about AI, was built, as I mentioned earlier, Builder AI raised $450 million, and in May this year, so this month, filed for bankruptcy. And I think there was a few strange things going on inside of the company, particularly when it comes to accounting, and even the delivery of the delivery of the service that they promised. Also, I don't know if you guys have been. I do scroll Twitter every now and then, and there have been some funny tweets around the lines of $10 million ARR in 60 days with just 15 people. Do you believe it? 45 days, 36 million ARR. I mean, I don't know what I'm doing
miracles.
here. Sounds easy.
What verticals was it, or what industry?
One was a
Not construction for sure, no?
not construction, but one was one of these what do you call them? Like
App building co-pilots.
exactly.
Yeah.
That's the one. That's what I was looking for. And the other I'm not 100% certain for. Also,
I think.
add. Go on.
No, I think the smart investors, he would ask a question: what's the gross margin of those, right?
I think we will get there. So, Patrick, you actually released the episode. This was another trigger to dive into this subject today. Patrick has been this week practicing his role of court jester with an episode that he released about perhaps thinking about whether VCs have been orchestrating transactions between their own portfolio companies, which may be creating an illusion of growth with no market demand. And finally, also just some sentiment that we have on Bricks and Bytes, speaking to some corporate people within the AEC space. I think they're getting pretty fed up actually of the AI arena generally.
Oh yeah.
Yeah, I think that the skepticism is at a very, very high point. and I don't think they really want to hear about your AI anymore. So,
I mean, they do want to hear about how you're solving the problem and what outcome that you're solving, providing. Yeah, there's like lots of noise about AI, but what's the outcome?
That's right.
so I guess let me just ask an open question before we go into the detail of build AI. How does everyone here view AI right now in AEC or maybe in your life day to day?
I think it's a great tool. It's a great tool, and you need to understand the limitations of that particular tool. And if you do, it can enhance your ability to be productive, your company's ability to be productive. But if you think that it's the solution for every problem, then you're going to fail and stumble with it.
Yeah, for sure not within the next 5 years. Yeah, might be solutions for some verticals in the 3, 4, 5, 7 years from now, but for sure not yet.
How about you, Patrick? Am I opening up a very broad discussion here by asking you this?
I think you are, and I think you know you are. So, so for me, look, there's a couple of sentiments that I have when you ask the question that way. There's different layers and perspectives you can take. Blah 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 blah. Let me just go
Agreed.
as it comes to my mind.
Mm-hmm.
So number one, I dislike how dumb AI is making people and society. That's like me speaking about the societal aspect of it. I think we're losing a lot of capability of critical thinking, and the discipline and the exertion of researching and thinking for ourselves. That I know it happens to me every now and then, and I have to catch myself actually to then, no, I have to do this exercise. I have to do the spreadsheet myself.
100% agree.
Right? And so I think it resembles in that way the introduction of like instant messaging. I mean, we're all, I don't know about Martin or Owen. I guess, Dustin, you and I are probably, if I have to guess, similar generation. We know ICQ, right? So that's what it all started for with me. But people weren't always online. It was peer-to-peer. It wasn't truly...
I think our generation was Habbo Hotel, Patrick. As in me and
I'm
Martin.
going to clock out on that reference. But the point is, right, so, I mean, if you then look at the generations that followed us and how they grew up with instant messaging, I mean, fuck me, they lost capabilities how to spell and put interpunction into it. And that's not because they're dumber than us. It's just that they lose the training, right? And the care for it. And I think that's what AI is doing. So I can go into other directions. But for me, that's actually something that, honestly, yeah, societally, I worry about it. And then there's other aspects that we can mention.
And the same we could say when there was first iPhones or first Instagrams out there, or first YouTube, yeah, because there was the same kind of wave of something new, which you could see is taking consciousness and like a conscious decision making from people. Probably 80, that's a problem of 80% of people. I don't know what's the number. I would like to think we are in the smaller percentage of that, we will just use it as a tool rather than as a completely tool on which we rely every day fully. But I just wanted to mention, last week I had two funny emails, two different customers, potential customers, sending me drawings to price the engineering for. And the emails that they sent over were completely AI generated. Yeah.
Okay. The cliffhanger.
Can you hear me?
Damn emails.
It happens.
Yeah,
Can
to
you hear
your
me,
point,
sir?
it reminds me, Patrick, what you say about, I remember when AI was first coming onto the scene, and I don't know if you guys are familiar with Robert Greene, who's an author, and he writes book like the 48 Laws of Power. I think that's the right number, and various others. But he said AI is like, will be like climbing to the peak of Mount Everest without actually having to do the climb. So you don't have to put in all the hard work and everything to get there. You just get to the top. And not
Hmm.
top not being like the best, but like you don't have to do the hard work essentially.
I think that's a good metaphor. It also sometimes reminds me of these 80s, 90s commercial ads on TV where they would sell us electrostimuli ab trainers. And that's how you get abs, right? So
8-minute abs, and that's it. All you have to do is this training video.
Yeah, nothing else.
sit on the couch.
Oh man.
I think when you democratize, like AI, it democratizes accessibility to information pretty instantaneously. Now, there's some questions about whether or not that information that AI provides you is contextually correct and thoroughly researched, not using biased sources. But let's just say it becomes very, very good at providing you, for the most part, unbiased information. I think, though, that what this is going to end up being is the people that actually really succeed are people that really invest in their interpersonal skill sets, because that's how you're going to start differentiating yourselves. And we actually have a society where the ability to communicate is diminishing. The ability for people to speak, like organize around a particular objective and manage people, like all of those things have eroded tremendously. So these AI tools are further compounding an already apparent to me trend of people are losing their social skills and their ability to work within others and collaborate outside of writing a message on Slack. And I love Slack. We use Slack heavily at my company. Sometimes you got to get on the phone. Sometimes you got to get in person. And I still haven't seen a single tool, and I've used a lot of tools. I love Notion. I love a bunch of different tools. There is nothing like a whiteboarding session with a product team to start brainstorming ideas and working through those things. There's nothing like getting everyone together and rallying the team around a common goal or mission. So if I was in my early 20s, that's what I would be realizing, is that, look, all the information is going to be there. So it's the people that can take the information and communicate the most effectively. And ultimately that comes back to sales. This is why I actually think sales is so undervalued sometimes in people's minds. Like, if you're a great salesperson, you're always going to have a position.
Wonderfully said. Hey, Martin, can you fill the rest of the story, because we're all sweating to hear what these emails said.
Yeah. Sorry. So I had two emails last week from two different customers asking for fee proposals for structural design for their homes. And both of those emails had obviously the drawings incorporated, and the emails were like, 3 pages, A4, asking me very detailed questions about every aspect of the design. And so we say that, okay, in engineering, we will have, thanks to AI and automations, we will have our job done in a much simpler way, just because of the opportunity of technology. But on the other hand, I experienced last week how painful it is to get a customer who is non-expert asking lots of different questions and inquiring about completely random stuff and unrelated stuff to their project, just because they typed something in ChatGPT. It was nightmare to respond to it. And these are not like super high value jobs, so it's just better to neglect
Couldn't you
them.
paste it into AI and ask AI to respond?
No, but that would be silly, right? That's not professional in any way, right? So
I
yeah,
think that already makes you exceptional, Martin. And I think what you're pointing out is that our loss of communication ability, Dustin, that you're referring to, it's gonna get worse, because we're going to spam each other with so much thoughtless shit.
Yep.
that was exactly
the only
it.
way out, right?
Yeah.
It's actually coming up in hiring. Everyone, normal IC positions are typing responses to offer letters like, hey, what's the fair market value of the last 409A? How many outstanding shares? What was the last price per round? Can I get a double trigger acceleration and it's like, where did you learn all this stuff? It's ChatGPT.
Yeah.
Well, did ChatGPT tell you that ICs are not getting a double trigger at any company?
It's interesting because how in the future we will then figure out how to filter all of this information. That's something which is a mystery to me.
It's fine. I appreciate when people are curious and want to learn more. But
certain stuff you don't have to, right? You shouldn't even, because you're messing up the process where you're involving professionals who are supposed to like give you all of the answers and do the thing for you. But suddenly you need to, someone is trying to do the work efficiently, and you are making them do more work just to educate you on things which completely you don't have to deal with, because the professionals took 10, 15, 20 years to communicate between each other effectively, so that they don't have to educate you.
I mean, that'll be the conflict that, and this goes back to being a really effective communicator. The people that can help articulate to the common person who's getting a data source, ChatGPT or whatever it may be, that conflicts with what your experience tells you as the domain expert or the professional, is it's an opportunity to succeed, because so many professionals will stumble in that environment where, yes, they're more armed, but they're more armed with bad information. And if you can make them feel comfortable with why that information is incorrect, you're actually going to gain, in my experience,
Credibility. Yeah.
Yes.
Mm.
Agree. Yeah, just interesting, because it never happened to me, and suddenly in 1 week two different cases.
Mm. Sorry, guys, I'm
AI
back.
is coming.
I think that someone has launched a cyber attack on Bricks and Bytes. Whoever it is, we're not
Yes.
Marks and Spencers. I don't know. That joke might not go down.
We can't afford ransoms.
Yeah. It's not worth your time. Shall we go into the case of Builder AI then? Maybe this sums up the situation we're in right now. So I will just read off where the situation, so people are familiar, and then we can dive into it, because I'm guessing it will open up some discussion here. So Builder AI was a UK-based AI startup founded in 2016. Original name was Engineer AI, to simplify app development through an AI-driven platform, promising to build software up to 6 times faster and 70% cheaper. Oh, that sounds very familiar. Backed by major investors like Microsoft, SoftBank, and Qatar Investment Authority, it raised over $450 million and reached unicorn valuation of near unicorn valuation of $1 billion in 2023. The company filed for bankruptcy in May 2025, so just now, and there was significant operational and financial issues. So in 2019, a Wall Street Journal investigation revealed that Builder AI relied heavily on human developers in India rather than AI for most of its coding work, despite marketing claims of automation. This led to accusations of AI washing. That's a term that comes up more and more each day, where the company exaggerated its AI capabilities to attract investors and clients. Former employees and critics noted the platform was more of a traditional development shop, with offshore contractors undermining its low-code and no-code branding. Should we stop there for a minute? Does it make...
Actually, one detail is important here of why Builder AI came to an end so abruptly.
Mm-hmm.
They took traditional debt and they breached 2 covenants with the lender. And the important covenant that the lender used in order to call back their principal and effectively bankrupt the company in doing so was that this lender was saying, hey, you overinflated the revenue numbers.
Mhm.
And now that I audited you, which many lenders up to after a certain size will actually have the right to audit you. Sometimes I have a company that gets audited quarterly because it's a fintech. They have a right to inspect those numbers. And if they then find some wrongdoing there, well, then that's the curse of debt. They can actually bankrupt you, and that's what happened.
Yeah. So to your point, Patrick, here's the note. So Builder, they overstated their revenue by 20 to 25%. 2020.
Oh, just 20, 25%.
Yeah, I mean, yeah, it's not too bad. But
Wait, you're being sarcastic, Martin, right?
Oh yeah. For those who can't see my face.
Just making sure we got the
2023 revenue restated from 175 to 185 million down to 140 million, and their 2024 forecasts were reduced by 25%. The company blamed aggressive discounting and failed deals with Middle Eastern resellers for the discrepancies.
Well, there's zero room for discrepancies on realized revenue. It is not ambiguous. forecasting, hitting 25% of your number and from 23 to 24, that's not all that shocking, or 24 to 25, because people were revising forecasts a lot over that span. But the discrepancies in realized revenue, those are actuals. Those either happened or didn't, and that's fraud.
Yep. And to Patrick's point, it said they drew down a 50 million in October 24. So this is now 5, 6, 7, 8 months or so ago. They drew down a $50 million debt facility, but lenders seized over 40 million in cash just now in May 2025, citing technical covenant breaches, which crippled operations and ultimately led to insolvency. There you go.
Mm.
And apparently,
what
just one other point, sorry, Martin, before you go.
That's okay.
Founder and CEO Sachin Dev Dagal stepped down in March 2025 amid a legal probe in India for alleged money laundering, which he denied, claiming he was only a witness.
Chef's kiss.
Well, I think that's not difficult to speculate what was the case with the fraud or not. But what this got me thinking about is in construction, builders, contractors, larger companies, incumbents, they want stability of outcome that they get from software providers. Yeah. So what are your thoughts, guys, when we translate this into construction? In case the companies that are producing the software right now, startups, are they, in case they go bust or there's a failure within them, will they not kind of bankrupt or bring down larger companies which would rely on their software or solutions?
I tell you.
I guess this depends on the penetration of the software within the incumbent, right, or GC, and how much of the technology are they really using. Any thoughts here?
I have a bunch of thoughts on this topic. So when you're selling enterprise software, depending on the size of the contract, I have seen companies want to know what our financial stability outlook is. So want to understand what our ARR model is, how much cash we have on our balance sheet when our next fundraisings is anticipated, what our goals are. Those are large enterprise conversations, and that's the only time it's really appropriate to disclose that. So if the deal warrants those discussions, the software company should be ready to have those.
Dustin, quick question. Could it be the case that software companies would lie about these figures?
I think there's a case that people lie all the time. I mean, lying is never a good idea, because once you lie, you're always following up with another lie. I have specifically, actually, an instance with Edify. I do know of one company that when they were evaluating software, thought we were too early. And, my rebuttal to them was, we had a very good balance sheet, but we are very early, and they're looking for a very large enterprise customer. This is over a year ago, over a year ago. But it was, look, our team and myself have already grown a company, and we're not limited to our ability to raise capital. So it is also part of the sale. And that's something that someone needs to become comfortable with. There's also covenants, and depending on your setup, we offer both multi-tenant and single tenant. So we could actually provide them the code should we fail and they need to operate it themselves in a sort of single tenant environment. But hopefully it never comes to that. I actually want to talk about debt, because I've been a part of businesses that have venture debt or some sort of debt vehicle tied to revenue. And those covenants, a lot of CEOs don't pay attention to them. They don't even know what's in the documents. They just think you can draw on this line at any time, and they treat it as actually cash on the balance sheet. It's not cash, it's debt, it's separate. There's only a couple proper use cases. I do like having a line of venture debt if I'm operating a business as a security blanket. It makes me feel better. If the business is going well, you can delay fundraising because you can fundraise really quickly. And that's really the only appropriate time. If you have to draw the venture line to keep the business going,
That's bad.
it's just not, it's almost not even worth doing. But it's there really to give you the maximum amount of time to continue to execute in a good situation. But having a security blanket can also just lower the anxiety. This is to all the founders out there. Try anything you can to lower your anxiety level, because it's already stressful enough. And these little things that can help, I would encourage people to do.
What's the interest on this debt?
So unless you draw it, it's zero. When you draw it, it's, usually, what is it? Probably right now it's like 9.5, 10.
And to just understand, Dustin, this is like almost like a safety net, perhaps. If you really need it, you can just call on it as and when required. Would there be any kind of requisite to you getting that money, or is it like there if you need it? Would you have to like prove something?
The proper use case is you do the next round of financing, then you approach a bank and go through a venture debt process. It's usually straightforward because your data room, they'll just use that to determine the amount. And then that can vary between, I've seen it as low as 20% of the round and as high as 50% of the round. The only other really good use case, I'm curious, Patrick, what you think, is if you want to, if you had an opportunistic tuck-in acquisition because things are going well, and that venture debt could supplement part of the cash and then do it some sort of stock transaction. That's actually what we did with Building Connected for TradeTab.
I mean, if I were religious, I would say amen. I'm not, so I'm subscribing in another way, and I can add and build on it, Dustin. So a lot of founders, when they haven't dealt with debt before, it is a very complex form of capital. We shit on venture capital all the time, and rightly so. It is very expensive rocket fuel that fits only very certain instances, but it is simple. In a way, it's not hard to understand, and it comes with a catch of dilution. It comes with a catch of some governance, but in the end, well, venture capital cannot bankrupt you. Debt can. And if you don't understand it, it's very dangerous. But if you master it, you're going to be in for a profitable ride for your company. And the following situations are the ones where we, here at Fundamental, we like debt. One, be profitable for the part that you are raising debt for. The reason why I phrase it that way is the part that you're raising for could be a specific country that is profitable and cash flow generating. It could be a specific division of your business. It could be perhaps that you have a financial division as part of your business. Maybe you have a software business and then you have a financial product next to it. And if that is a separate facility that you put it in and it's separated from the holding company and that facility is profitable, that's a good use case too. Or it could even be, I've seen a robotics company recently that actually gets SPVs through which they finance these robots. And the robots themselves are on 36 months lease contracts. And that facility basically gives that company the working capital to produce these, but they get the invoice factoring of the ARR of the robots. Also a great use case because that part of the business is profitable. So that's one. Whatever part of business is profitable, do consider debt, but classic debt rather than venture debt if you can. Then, if your business is a working capital intensive business and it is profitable, that's like a prime use case to load debt onto it if it allows you to access higher margins or somehow accelerate very fast. So our best cloud manufacturers like Inframarket, Metalbook, Brick and Bolt. I have a German company that is an Inframarket for Europe. They are doing that. And it allows us oftentimes to, when we raise equity for a Series A, it's oftentimes a 1-to-3 ratio. When we raise Series B and C and are profitable, it's oftentimes even a 1-to-1 ratio, where the amount of equity you can load with classic debt. But here's the third condition. If you're in a volatile market like ocean freight logistics, for example, there's always a cyclical element to your market that can make you unprofitable for 3, 6, or 9 months because you might actually triple your tonnage, but because the rates drop so much, your revenue might actually be lower in spite of you doing more operations. And then all of a sudden, what was a previously profitable business is unprofitable. And if you now have to retire debt in that time frame, in spite of you being profitable in that part of the business, you can actually kill yourself. So that's these examples where, Dustin, I think that you're rightly pointing and cautioning founders. It's a dangerous instrument, but if you master it and if you are not volatile, you're profitable in that part of the business, it's a fantastic one.
Yeah, I mean, if you're doing a hardware software company, you almost have to have a line of debt in order to make the financial structure work, where you can pay for some of the manufacturing on this revolving credit line. But my first comments were almost entirely to pure SaaS plays, and almost entirely pure SaaS plays. I just see early stage first time founders thinking of them as cash on the balance sheet, which is the most dangerous thing you can do.
There are these. Have you ever tinkered, Dustin, with these new age players? I think they emerged somewhere around 2020, 2021, where they invoice factor your ARR revenue. Have you ever tinkered with these?
I haven't. I've heard of them, but no, I haven't. Have you?
Okay. No, neither.
I've got someone who uses it, but this is not a startup. They have like 200,000 euros monthly invoices, and they use it, pay having 1.5% on it, something like that.
Okay. Yeah, so 12, 18% annualized. I mean, not cheap, but could still be cheaper than venture capital, depending on how you play your growth rate.
Patrick, I have a question. Go on.
On this venture debt, how compelling it is, because in case if as a venture capital, if you're investing in startup, you're taking the equity and the upside is potentially good, huge, large. If you're getting 10% for a debt that you're issuing to someone, then it is 10% of something that can be still zero. So 10% of the cash you're getting on the money that you are lending, right? But it can all go to zero if they don't have cash flows, or they don't break even on this. Seems like from outsider's point of view, seems like very unattractive way to put your money into work.
Sorry, are you asking why are the venture debt providers doing it, or why should the startup?
Yes. No, from the venture debt providers' point of view, quite risky for 10% or whatever it is.
Well, it's not just 10%. Over every bank that you're going to get venture debt is going to require you to also deposit your capital within that institution. So it is an attractive way to encourage businesses to flow to your bank. This is what SVB was particularly good at and why they became a behemoth in the startup scene. And they had almost no defaults or very little defaults on their venture debt programs. They also, venture debt comes with a sliver of equity within the business. So SVB owned like 0.25% of almost all Silicon Valley. And if they just knew how to hedge correctly, they were a behemoth. So if you make
almost like the bottom quartile of an accelerator that is very profitable.
That's right.
Hey, could it be also the case with these debt that you're putting some kind of personal collateral down too, as the main director, CEO, founder?
No.
Fair enough.
You're already putting your personal capital down. It's your equity in the business.
Yeah, fair enough.
Yeah, but if it goes to zero, then
they're not going to come take your house.
Yeah.
No.
Yeah. I wanted to ask you guys.
Not if you choose the right legal structure. No.
I wanted to ask you guys about. So I think Owen was reading early. These companies generating 10 million IRR and 20 million IRR after 60 days, etc. What is IRR? Is it because it means annual recurring revenue, right? How annually reoccurring it is really? Because how do you know as a venture investor that it is going to reoccur next year? Like because it's a magical word, IRR, annual recurring revenue.
Yeah, because what you're saying is if you have a 1 mil ARR and then they cancel after 1 year, then it's not recurring. It should just be 1 mil revenue.
What's the guarantee here? Like that this is reoccurring? Because it sounds like it's gonna come next year based on this three magical letters, IRR, right?
It's a super loaded question. Dustin, you want to take a first step?
No, you go ahead. I mean,
Okay. So I try not to make it short.
IRR is different in my mind than ARR.
No, he's saying A. He's saying ARR.
Okay.
Oh, he knows me better. Sorry.
I understand the accent a little
My
better
accent.
by now.
Martin, you're I guess consciously asking a very loaded and smart question, and one that we forgot as an industry almost the answer to, because we became so obsessed with the heuristic and we forgot the first principle. So think of a magazine subscription in the 80s, right? So magazine subscription in the end is usually
Like
not
Playboy.
Sure, you're
Yes,
like Playboy. Yes,
that was one.
that's exactly what I was thinking. Yeah.
Okay.
Uh,
Now I can see that.
Most magazine subscriptions would be on a monthly basis. Some of them maybe would be for 12, some maybe longer. I don't know, right? But so actually, most of them would be MRR, not ARR. So it would have been incorrect technically to say, hey, this customer has a monthly subscription with monthly cancellation rights, and that's why 12 times that is ARR. That is incorrect. It would be annualized MRR because it's monthly recurring with a monthly cancellation right.
Uh-huh.
Now imagine this customer had, after 10 days of a monthly subscription, the right to actually rescind on the subscription entirely. And yet, while they are in that trial period, you would count it as MRR.
Yeah.
That would not be correct to do that, because they are still very likely to churn, right?
Uh-huh.
And so that's something we have we have forgotten to understand. The attractive part is, yes, there is a stickiness to the product that people will forget to cancel. It's more convenient to just carry on. They are not going to make another procurement decision next month to compare two different magazines. You know, I'm happy with the magazine that I have. Maybe there's a more perfect one out there, but I'm happy where I'm at, and that's why I'm just going to continue. So that's what makes it very sticky. That's what makes the next dollar acquired for the next month very, very cheap. And that's great. That's fantastic about it. But that doesn't make it annually reoccurring. Annually reoccurring would be it's a 15 months, 24 months, 36 months contract.
Mhm.
And then it really becomes ARR. I begin to count ARR at 12 months contracts, because then at least I can make an argument to say, hey, very likely it's going to be sticky. There's some NRR expansion perhaps,
And they'll
even
get more
etc.
business from other.
But when it's MRR, to call it ARR, it's technically already incorrect. And when you then even have early rescind, you can cancel within the first, let's say 30, 60 or 90 days. It's even more wrong.
And some people do that, Patrick, whereby they would have like a, I don't know, subscription of $1,000 per month and times this by 12 and say, oh, we have 12,000 ARR.
All the time, man. All the fucking time. Of course. That is, it's like, look, man. Sorry, Dustin, before you go, this goes even further. You wouldn't believe how often you meet marketplace founders who make GMV on a transaction basis, annualize that GMV and call it ARR. Like, I can't tell you how unbelievable.
Jesus.
It's like,
Yeah, it happens, man.
Dustin's your
It
face.
happens, and not
Dustin's
just once.
face is so funny then.
it's like
Well,
it's like,
You just see people confusing these metrics left and right. And I look at some of these things. I'm like, how did you classify it like that? And it blows my mind, because like, sometimes I'm a really simple person. And like, just what was the intent here? The intent was, all right, Edify right now, we sign year-long enterprise agreements. Sometimes they can be multiple year. That's ARR. Someone signed up for a month, they're signed up for a month. And then the investor needs to evaluate how sticky that's going to be. So I tell SaaS founders, the most important numbers is not your ARR. The most important numbers are your growth rate and your net dollar retention. Your net dollar retention factors in logo retention and expansion, and your growth rate tells you how quickly you're going to grow. So then you can start dissecting them on what percentage of that new business, what percentage of that's net dollar retention. But net dollar retention is by far the best number of a SaaS company. So people that are marketing ARR, I would hypothetically guess they are probably doing a lot of what Patrick's saying is new hype product many customers signed on for a free trial, which could be canceled at any time. I can't tell you how many apps on my phone I've gone premium, free week, canceled it within a day. Within a day.
Within that minute.
Hey, do you do that? Do you ever do that thing where they make you put your credit card in to cancel? Then, like before you even start using the app, you quickly cancel, then start using the app.
Always, always.
So
I'm not feeding the SaaS software people with my dollars.
I tend to discount any company that is posting growing this to this with, because it's one metric that does not give you enough information to evaluate the quality of that number, and so it's just a number. And if you take, I mean, two companies both at 5 million in ARR, one could be valued at 50x that, and one could be valued at 2x that. Because if you went from 0 to 5 and this was true ARR in 18 months, that is a highly valuable business. That is growing, and these are enterprise customers and all of that. And if you're at 5 million and you've grown 5% a year for the last 5 years, that company isn't worth anything. And so you don't have enough context to evaluate it. If anything, it's just a marketing tool.
Dustin, since you mentioned this net dollar retention and growth rate, like are these kind of universal like ratios, or these are numbers specific to tied to a company or revenue, and they are not like universal? I mean, by that I mean, is it like 0.5 is good for, or 0 or 1 or 2 or 5? What's the good net dollar retention or net or good growth rate?
There are certain ways that the venture community likes to see this information reported, and expectations of what good, great, and outliers look like. But everything still has to be put in its place for that specific business. And this is where I think a lot of opportunity in investing comes from, is understanding why a particular business might be exceptional, even though people are classifying it as good. And this also happens where people classify something as an exceptional and it's actually just an average company because of some extenuating circumstances. But yes, you can do, I mean, this is what every founder should do, is just understand SaaS economics if you're a SaaS company, understand these fundamentals, but then understand how this relates to your business. Because your business is unique, hopefully. And you should tell the story about what numbers really matter to your business and why you are driving on these KPIs versus those KPIs, and why these are the leading indicators and those are the outputs. Because a lot of people miscorrelate inputs and outputs and have a hard time contextualizing that to the outside world.
Okay.
Back on the Builder AI case, there is some interesting opinion here from a piece I found. It says it's a big moment for the AI industry as the pressure for AI companies to actually come out with a usable, not to mention sustainable product. Though AI companies accounted for 40% of the money raised by US startups last year, the vast majority of them have yet to turn a profit. And many AI startups struggle to find any consistent revenue stream at all beyond the tech-crazed venture capitalists, and a not insignificant number have been caught misleading investors about the AI's capabilities to keep the cash flowing.
I talked to
Smoke
a
and mirrors.
VC. I talked to a VC yesterday, and we were guesstimating, because of the sheer number of AI companies that have raised capital, if you just did it on a company basis, I'm thinking 90% to 95%. There's going to be some tremendous outliers, but just go to 0.
How much? What percent did you say?
Above 90%.
Yeah, interesting.
It might be 95%.
Might be even now more with the AI frenzy situation that it was usually for SaaS, right? Well, I'm saying I was in this industry for a decade, but based on what I heard.
Patrick, how is the volume of pitch decks coming that are AI in the VC world that are coming over to you?
Sorry, can you repeat the question?
Like, how many of the pitch decks that you're currently receiving? Like, what's the sentiment generally? Is it like majority AI or not so much? Is it slowed down, sped up?
So I'm probably not the best judge of exactly that question that you were asking, that someone in a generalist firm will have a better sense of that as a part of the overall market. But what I can tell you is that the amount of pitch decks that all of a sudden have the word AI on the front page, yeah, that has changed tremendously. And it almost filters a lot of companies easily out for me, not because I want to be, whatever, a dick about it, but it tells me that it's a signal that you haven't been thoughtful about the non-obvious part of your business. If the non-obvious part of your business, the best part of that is that you are AI enabled, that's very likely not going to translate into my taste for non-obviousness, A. And B, a lot of the things that really make our sector better, in the end, you can do with AI or without AI. But what's going to make it better is some critical workflow in how we stack atoms on top of each other needs to be improved. Sometimes it's the physical part of it, sometimes it's the pre-construction part of it, but anyhow, somehow this workflow needs to feed into someone putting atoms on one another. And if the best way that you can do on the most important slide of your deck, which is the cover page, is to emphasize that you're AI enabled, it's not a good signal. I had a quick anecdote. I had a review of a pitch deck that a angel sent me today, and the pitch deck read AI enabled CFO for XXX in construction. I wasn't interested in the business. It lacked pretty much all the ingredients that fit my taste. And I wrote back to the angel, not to the founder, to the angel, and I said, man, get rid of that AI on the front page. They really need to improve what is it that is unique about their take on the business here. And so that happens a lot.
Also, one thing I've observed, we obviously speak to a number of corporate people on Bricks and Bytes, and mine, I don't know if you've noticed this too, but I think probably maybe 6 to 8 months or so ago, it felt like people were very positive and excited about AI. But I've noticed maybe within the last 2 to 3 months, the conversations, people are getting way more skeptical of what's been thrown about, and they're not so as excited as they used to be, and they approach it from more of a like, oh, what do you want from me, as opposed to, yeah, let's hear what you have to say.
Like I said earlier, I think it's people are looking for the outcomes rather than just a promise of technology solving a problem. Yeah, so they're looking for the outcome, and I guess they tried a bunch of those solutions, and they're adding probably confusion rather than solution or outcome, and that's why it is what it is.
Very happy to hear that.
And to add some confirmation bias to this, when I was researching this morning, I found a February 2025 study by an independent research firm, Tech.co, found that 58% of businesses using AI were doing so because of pressure from competitors, not necessarily because like they need the AI or they want to use AI, but because their competition are. So all the more reason for businesses to be aware of people exaggerating AI capabilities and claims.
Actually, let me ask it's a genuine curious question. It's not a trick question. It's not suggestive. Genuinely curious. So if you think of the following, let's say, era-defining technologies: the internet, the cloud, and AI. How would you rank these in terms of impact?
Dustin, do you go on cloud?
It's really great. I mean,
I think they would.
No, the internet is the backbone of everything.
Exactly.
That is the most defining thing ever. It improved communication. It brought the potential for everyone in the world to interact with each other. No, and then everything is found. If you look for things that are foundational, it's foundational to all the next innovations. So without the internet,
What's the competition to cloud, for example?
Citrix.
Local device. Citrix.
So is it not just the next leg of evolution for these things? Internet was a base layer. Then you have the cloud, which is the next obvious. Well, not next obvious, but the next technology which was possible to invent to allow for things to happen. And like AI is just the next one, and it's probably not the end of those. There will be it's only been 25 years of not 25, 30 years of like internet, right? So
Yeah, I mean, so some of the AI solutions are less of, all right, let me position this. My first company was Building Connected, right? We created this network for inviting subcontractors to bid. I have seen AI companies that are saying, hey, we through AI will help with your bidder selection process. The difference between what we did and what they did is not that different, because in order to support our network of literally millions of people across the United States and Canada, we create a very sophisticated algorithms to find them contextually based upon the project's location, what scopes of work, the size, who they work with, the particular trade you're searching for. So were we already doing AI? In the classic definition, no, because now everyone thinks AI is just language models. So they're
connected.
yeah, it's
Yeah.
making these new models are making it easier for people to participate in things that other companies were doing, and to some extent, for the last 10 years or the last 15 years.
Yeah, and now you will have AI built on the cloud, and which is running on the internet. I think it's just, I don't think it's a classification of these things what's most important or consequential, but it's just another thing that comes after certain period of kind of steady, not steady growth, but no non-growth within the internet era or information era.
Hey Patrick, what I would respond by saying you missed one thing off the list, and that'd be cryptocurrency. And then what's your opinion?
Well, actually,
Here
if I can jump in, when we talk about like AI flooding the mailboxes and just making our life more difficult, I wonder if these crypto blockchains, they will not bring some solution for authenticity of certain information that we see, as that's what the blockchain promise is, to provide authentication of certain outcomes. So I'm actually curious to find out more and see if there is something in it, but I don't know if there's any promise, because that's what blockchain is for, really, right? You can't make it up. You can't forge it, certain like protocols. So yeah, that's what is interesting. But I don't know much about it to speak about it too much. Yeah.
I'm going to answer in jest, Owen. Perhaps you all noticed how Ryan Cohen, the CEO of GameStop, now bought 4,710 Bitcoin.
it's like 500
yesterday.
million worth, yeah, dollars worth.
So I guess it's very transformational. But no, I wouldn't put it into that list, because I think we're talking here about an asset class that, even when it doesn't have the utility that the other three technologies would provide mankind, there's another reason for the demand for it.
Well,
that other reason is not the same in these other three technologies. So not to sound abstract, but that's the reason why I wouldn't put it into the same list. I think that it's completely different reasons for demand. Until crypto / blockchain would prove its utility, which, I mean, no, but actually one that did miss in the list, it's not a technology, but perhaps it's still an era-defining application of technology, is actually social media. I would be curious how you all would re-rank the list if we included social media in that.
Very interesting.
Yeah, still internet first, but social media would be a strong contender.
It's more like a social concept.
I think there's a debate if that's been a net positive or net negative effect.
Well, we are on it. Yeah.
That's probably a better debate.
Yeah.
I think that mobile is also
Yeah,
that's right.
that
That's
was a
missing.
really redefining solution.
Yeah.
but it's,
I would put mobile ahead of AI still.
Yes, yes.
Patrick, but to your point of the utility for the blockchain, what if the utility is to provide authenticity to certain things? We're in the era
Yeah, but
that
mine,
you
if
can
a
make
human
up
is
everything
if a
you
human
want.
is using the AI, then how is it going to determine that? How would the blockchain add authenticity here?
That's what I'm saying, that I'm curious of any practical solutions of blockchain, because I know that that was the promise of blockchain. Certain protocols to provide to authenticate if certain things are not forged. Yeah. So I think I'm hopeful that that
Why
might
don't
be
you ask AI?
Yeah.
I think that the argument for blockchain on authentication and just is like just to be a universal authentication system is weak. If we wanted to solve authentication, it's not a problem we couldn't solve. If the world agreed, hey, Apple, solve authentication and be the authenticator, they could solve it today, and it doesn't require blockchain.
How do you
Face
know that the
ID.
Apple is not forging anything or not inflating anything?
Regulation?
Because you have to trust to an entity. Someone is governing this entity.
So, Martin, we're really getting into a blockchain discussion.
Yeah,
now, but
he's
let me
sucked us
still
in.
add-
He sucked everyone in
But
here.
let me add my flavor to it. So the Greek have a saying for what you're saying right now, Martin, and the saying is "quis custodet, ipsos custodes." What
that one.
means
Oh, yeah.
is what that means is who controls the controllers, right? So
Mhm.
that's what that means.
Immutable
And-
ledger.
But the thing is, so that's where I'm having a trouble with your argument is if you put shit into the front, all that blockchain does is validates that it's the same shit. Okay. So in the end, the problem is for your authentication in case of, hey, I get AI spammed. If that would work, we wouldn't have bots on Twitter. The very fact that we still have bots on Twitter and we need to eliminate them with a $5 monthly subscription or whatever that is, and we need to flush them out, already shows you that blockchain is not the answer, because you can only, sorry, I know I'm oversimplifying.
Yeah, that's fine.
Blockchain people, don't hate at me, okay? I'm oversimplifying, but I'm simplifying in the sense that really you are authenticating that the next part of the transaction is the same as the previous one, right? But if you put a bot into it at the front, it's still only authenticating that, yes, it's the same thing. So
Perhaps I don't have a strong opinion. I have. I just.
you don't, right?
I'm hopeful that there will be finally some utilization of certain protocols.
But isn't it interesting that none of us put AI at the top of this list? Not even near the top of this list.
As I said, I think it's just another leg of technology, and it's not something which.
Yeah, but I'm for 3 years I'm online. I read newspapers, and everybody tells me that this is the frontier that I should be investing in, that I should be founding in, that I should be buying, that I should be investing in funds in that invest in that. Like, how can it be if it's not the top of the list anywhere?
We must be
Well,
talking to
we are
different
also,
people.
and I'm probably not the biggest bullish on. I'm not the most bullish on AI, but we are in the early innings, and so its impact today has been very minimal. And so, where will it be in 3 to 5 years? It could be quite tremendous.
Fair enough.
I agree.
Let's debate this
Internet,
in
you can
3 to 3
say
years.
you can say it's been like world changing, but internet proof itself 20, well, probably more than that, 30 something years since inception. So yeah, but something like 3-4 years ago, you could say the crypto was the next internet. That's what people actually were selling the crypto for, to be the next internet kind of technology. But
Okay, but let me make a commercial/conceptual argument now why I think that these analogies to create AI hype based on what happened with these prior era defining applications/technologies is misguided. The internet is a protocol that compounded. The more people used it, the more valuable it became. Mobile, the more people used it, the more valuable it became. Social, the more people used it, the more valuable it became.
Yeah, great
And
point coming. I get it.
Cloud doesn't have a network effect to it, but cloud actually has economies of scale. I'm not understanding how either of those two is going to play out in AI yet.
Well, the more data you get from the
No.
the more
Incorrect.
good data.
We already have understood all data.
Yeah. People are actually going to get.
We can't aggregate this data. That's the point. We can't aggregate this data and make it smart use of them. I think that's the key. Because I've done 2,000, let's say less than 2,000 projects, the small, medium size of projects, and I've got on my disk drawings, calculations, Excel spreadsheets. Everything is there. But what do I make out of this if I can't aggregate it?
Okay, maybe I'm misunderstanding your point, Martin. Then help me out. But how can it be? I mean, Altman and Musk are saying their models have already read everything there is.
They wouldn't go near Martin's hard drive. They tried.
It's protected on Dropbox.
No, to your point, Patrick, I think that you will get to this point where the more people use it, actually, the worse it becomes, though. The AI, because it'll just regurgitate the same shit every time.
No, I think the application layer is the key here. When you have the AI doing really something with this data, aggregating in a structured way so that it provides some outcome, that's where the magic might happen.
So, Martin, you're actually leading to the point why I think many AI companies are going to fail is in the enterprise space specifically. They don't own the data lake. They don't own the workflow where the data is created. They sit on top of that and try to provide insights. And these models are becoming more democratized in that you're not going to have or need like the world's greatest AI engineers to develop these. The owner of that information is going to have the right to win that space on providing insights to the customers that are meaningful, because those insights can then impact the workflows that they're being created. Or you're going to see the data lake providers where they're aggregating across all applications for their businesses, all of their data set, then them building models on top of their proprietary information. So I'm not sure where that leaves room for, hey, I'm AI for this. Oh, what do? I use AAC. I query Procore and Autodesk. Okay, well, what's the defensibility there long term?
Which is more valuable to be. Exactly.
Yeah.
So,
Martin, your microphone has got really quiet, by the way.
How about now?
Yes.
Okay, I'm back. Defensibility. So that's a very good point. So I think actually that this is driving everyone and everything. Maybe not, that's too much said, but lots of solutions cost towards zero because it becomes commoditized to get structured data and to get to build a software, to do a software, and that's could be potentially available for everyone sometime in the future, which will drive the cost towards zero, which I love this point, because technology, that's what it should be doing. And that's what it has been doing.
I mean, I think it's going to be a long time before someone can say, hey, AI engine, I want you to replicate the entire Procore project management tech stack.
But we don't need that. We just need maybe 1 or 2 or 3 competitors, which will be operating on certain margins, not 90%. But certain margins and they will be doing the work. Yeah? Well, I'm talking from the customer's point of view, not from the startup founder point of view.
Yeah.
That
the data input.
Yeah. In the end of the day, you want things to work well for you, and you want things to be not super expensive. Yeah. When we talk about technology, when I speak about technology, at least. Yeah. That's probably opposite argument to the one that venture investor or startup founder would have. Yeah, but on the customer side, we want stuff to be doing the work and to be relatively not expensive.
Okay. I want to build on that, Martin, because I think the way you just ended that is very first principle, and I like that. That is precisely the reason why I think it cannot be compared to the other four, and why I think there's too much money going into that space too indiscriminately, which is not deserving that level of allocation. When I would think of the better metaphor here, in the 80s, we offshored before the 80s, we offshored manufacturing into countries that had a strategic advantage to produce the same goods at better structural, at cost, where they used their structures to unlock cheaper costs. And then in the 80s, we started doing that with services. Think call centers, right? And we did that for precisely the reasons that you just mentioned, because it is beneficial to have the same thing delivered at lower cost, right? That's the comparison that AI is, in my opinion. And so at some point, it's always like that. It's physics, guys. At some point, there is a plateau that you will reach. If an evangelist tells me, no, Patrick, you're not understanding it, it will keep compounding, and in 5 years, it is solving the entire universe, then call me a disbeliever. Like if you want me to believe in that, then I'm a disbeliever, okay? Because that's not what physics tells me. I mean, I understand thermodynamics enough to know that that is not going to happen.
No, I agree.
So I'm going to plateau the same way that, at some point I couldn't produce
it
fashion.
also requires that we live in almost a deterministic universe, right?
Right? I mean, okay, maybe it is the computer simulation. I mean, what do I know, right? But at some point, we are bound by certain rules, and those rules also dictated that we couldn't produce fashion cheaper than a couple dollars when we offshored it to Bangladesh. I think that's much closer to the reality of what AI is going to. Of the reason why AI is transformational for the next decade, than it is closer to the reason why the internet or social or mobile or the cloud was transformational. I think that is something why too much capital is allocated to it. We are going to hit a plateau before we're going to then compound again with
for sure.
AI.
For sure. Boom and the bust cycle is going to happen here as well. Yeah?
Yes.
And I also want to highlight, Dustin, I think you're absolutely right from your conversation with your VC friend. There will be absolute massive outlier companies born on AI. I'm not debating that.
I don't know if this is this year. They are started this year or in the next 5 years. There's no one.
Yeah. Martin, to your point, I have a genuinely curious
But the
question.
body count will be enormous.
Oh, for sure. Yeah.
The body count's going to be ridiculous.
If all technology was free, do you think you would run your business differently? If everything was commoditized and you could use any tech that was available to you on the planet for free, do you think that you would service your customers differently? Do you think that their demands would change? Do you think you would run how you do things differently?
That's a great question.
For sure, it will be different. But I think everything will come down in the end of the day to the cost of the energy that the country or someone can. What was the cost basis of energy you can use to deliver your service or give your product, right? So I think that's what there will be an issue in the next decades. Really, what's the cost of a unit of energy that you're working on? Because the software and it will becoming more and more commoditized. So to your question, I'm sure they will be different. I didn't put too much thought into it in the past. So what do you think?
Me? No.
Because
no,
you need to think,
because people I maybe alluded to in my question, customers' demands, human demands, what people want to do will probably not change. I mean, it will change, but not definitely not in our lifetimes at a scale at which it will impact me that much. So I don't think.
I think it's really hard to generalize everything. I think there's going to be compression because of competition and on what SaaS subscriptions can be in most fields. I think people under or discount while you build a SaaS company when at the enterprise level, it's not just the software. You have customer success managers. These companies require some TLC. Like, and if you're just saying I am just a software company, you are not going to be selling large enterprise deals. It just ain't going to happen. And then that like, and so people, the founders that think like I'm going to just do this and it's magically going to end up in every customer's hands really are naive about what's required to do an enterprise deployment. Like there is a deployment, there are SOPs within these organizations. You have SLAs that you're signing up for. All of these things cost money. When you sign an SLA, there are credits back. You're signing up to, what is my uptime? What are our response times? So there's some stuff that, and to our earlier point, one of the reasons why some companies might be afraid of using these on an enterprise level is because these require a certain level of maturity to even be able to support from a contractual standpoint. So
it almost sounds like it has been a lie when VCs and angels told us that product-led growth also works with general contractors. I mean, it's...
Well, then you have PlanGrid. PlanGrid did product-led growth. Like that was, they got to 5 million on just like nothing. Now, first one to the market, amazing product. I'm actually having dinner with Ralph and Tracy next week. But
tell them we want them here.
Yeah.
By the way, I saw Ralph's episode with you. I did not recognize Ralph.
Yeah.
Like he has gotten himself a nice new
look. He looks awesome. Yeah. Patrick, I was curious on your thoughts on the question. I saw your brain spinning.
Yeah. I don't know the answer. I do not know. My hunch is, so when I only apply to my business, my business is very simple, guys. My business is I have to convince someone to give me money on top of my own to, leverage the own money that I invest. Then I have to convince Dustin to give me his equity and trust me with that. And then I have to convince
me.
Convince
me. What?
Investment bankers or acquirers to purchase my shares for a price that I really, really like. Like, guys, that's my business.
Hey, Patrick, I was also just going to say you have to do the occasional podcast appearance.
That's hobby. That's hobby. No, but in between, obviously, I try to give Dustin and the likes 1, 2, 3 trajectory changing moments across those 10 years. But I'm not running the business. I'm not operating. This business wouldn't go anywhere if I did that. I can't do that. It's not my skill set. I try to give a trajectory changing moment every 3 years. None of these things that I just mentioned, I would do any different with technology.
I found that VCs use less tech than almost any other business.
That's a weird thing to think about.
I'll be a great VC then.
Hey, I'm on Superhuman.
That's a good segue into hiring.
Yeah, let's go there. I feel sorry. Well, I don't feel sorry. We just completely went on a rabbit hole. I don't think we covered much of what we planned to.
Can I just leave the Johnny Ive theory? Oh, sorry, just a thought provocation here with you guys. I just feel... Okay, so we had this WhatsApp chat among us and a few other friends, right? And so it's not a secret group. It's a very non-secret group. And I was just thought-provoking y'all. And I was saying, hey, guys, 6.5 billion to acquire a company of 55 FTE that is in the service space. The service space of IO is product design. I'll leave out whether IO has any royalties on products that they designed, because that will change the case a little bit, but probably not too much. But let's assume they don't have royalties and it's all a pure service business. Okay. With 55 FTE, if you were the world's most profitable bulge bracket law firm, I actually looked up the numbers, you would be making $2 million revenue per FTE.
Nice.
That would be 110 million per year. Let's say they are beating that by 2x. Okay, so you're getting to 220 million annual revenue.
And a
It's not
service
AR.
trade for 5-6x revenue.
Right, exactly. And so now let's assume great retention, because they probably deliver fantastic outcome, great reputation, they are great at relationship building, probably a very good growth rate, right? And overall, these margins at that kind of a revenue per FTE will be insane. So Dustin, let's give them 10x just for complete nuts, like whatever,
Why not?
SaaS like 2.2 billion, okay? If that's what it were. All these assumptions that I just listed. So you just paid 4.3 billion for Johnny Ive. I present to you my theory why they did that. Personal theory, personal opinion. I have no insider information. I'm not saying this is true. Don't sue me. Personal opinion, okay? I think why you do that is because you're running out of stories to justify a 300 billion valuation. I think you are now in the business of every now and then creating a new narrative to justify the next thing.
Sad.
And that's worth 4.3 billion to you.
That might.
God, I wish just me was worth 4.3 billion. Cool.
Right place, right time, man.
By the way, based on a quick Google I just did, Juan Soto, the 26-year-old baseball player, was his largest contract was 765 million. So that's the largest sports contract ever. So just to maybe, it probably doesn't exactly compare, but just so maybe people have a bit of an idea.
4.3 billion is like Michael Jordan's entire net worth. And you think about how much he is worth to the Nike brand and what he's done. I think that's right around his net worth.
4.6. You're right. Yeah.
Oh, wow. Okay, that's close.
And
By the way, great movie.
Okay, let's go to hiring. How do you hire the best people in the AEC tech world, Dustin?
So it's funny we're having this conversation because we are growing and we're going to be hiring relatively a lot, growing by like 25%. So
Nice.
we're 40, so putting 10 heads in a seat. And hiring is both art and a science. And a lot of people, when you're in a startup community, it's like your first time hiring. And so I need to work, and this is me just talking about Edify, on helping my team get better at hiring. And this is me being kind of transparent. Like, one of the things you need to do when you're hiring and talking to folks is qualify if that candidate is a good fit for the company as soon as possible. There's nothing worse than spending a lot of cycles in a hiring stage, especially on the engineering front, but on any front, investing a lot of these cycles only for them to get an offer letter and not say yes. Like, you should track how many offer letters you send and what the conversion rate on those. And that should be like 90+%. Because if you've invested all that time, your team should have conviction that this person wants to be here. So I think that's one of the things that a lot of companies don't do well is you need to not just be qualifying them, but selling them so that they're leaning in as you lean in more. And that convergence needs to happen. And that's like a methodology that is, I don't know if it's taught or practiced, but it's what should be done for the early stage companies.
Dustin, quick question on that.
Yeah.
How do you tell if someone is fit for a company? Is this based on like brand values or background or technical expertise or a fire in the belly is a term that comes up often on Bricks and Bytes?
Well, when you've talked to enough people, you can start pattern matching on what to look for. But like, the first thing is like, why? I always start with, why are you interviewing with Edify? I want to know where they're coming from that said, hey, I would take a meeting and sit down for half an hour. And if they had a good story about like, oh, I saw this about Edify or whatever company I'm working for, this really intrigues me, that's great. If they say, you know, I'm just starting a job search, I'm going to discount them a whole bunch. They have not leaned into the process and shown a desire to be here, and it's just not exciting to me. I mean, the person should show that they've done their research and diligence. Now it's on the company, though, to create an environment where people start knowing about you and that they can start reaching out. So this is where, and this is something we haven't done at Edify, it's something I did at Building Connect, and something I'd encourage people to look at is hiring a head of talent. And we're going to be looking at that role. So a head of talent is not just about sourcing, but it's about building all of the pipeline for where people can find you. So start with LinkedIn, go to Glassdoor, go to every vehicle that helps represent your values and who you are and what you're doing, works with any sort of brand or content marketing you have. That way, you have funnels for when people can come in so that people can reach out. Always be hiring, always be interviewing. You can be opportunistic. It is one of the most important things you need to do if you fall behind hiring. So this is also something that people don't do calculations on correctly. So most startups are cash burn negative, right? And so if you're delayed on hiring, let's say you're cash burn negative 200,000 a month, 300,000 a month, but you're delayed on critical hiring for someone 3 months, and this person is instrumental in your business being able to reach your objectives for the end of the year, you just burnt $900,000. Where that person needs a ramp and to be effective. It's the same thing with sales reps. If you wait 3 months to hire them, you're burning a bunch of capital, and now that ramp's delayed. So hiring means a lot. Speed to execute on hiring is super important. People take it lackadaisically. And early stage, the CEO and the CTO, the co-founders, spend some time on LinkedIn, hire LinkedIn, buy LinkedIn Recruiter, send emails, find profiles that you want, hire recruiters. It's too important. Like, people are squeamish about the recruiter fee. So you have to pay a recruiter $25,000, but your cash flow is $300,000 a month. Who gives two shits about the $25K?
What about any thoughts on onboarding and how to make sure that after you hire this person will have the quickest, you said speed to, well, I don't know what's the ratio here, but the quickest onboarding possible, because I don't have experience with startup hiring, but in a normal traditional business, you usually are hiring for someone who you believe will do the work, which you know the scope of exactly, and you're looking for the right fit, and the onboarding is kind of copy paste from one person to another if it's the same kind of position. What about how, I guess in a startup you have much more diverse roles, and it seems like to me it's much more complicated. Any thoughts here?
Only that I am not the greatest at the tactical component to onboarding, and this is why I hire people that are good at the tactical component. But everyone should get a general experience of what it means to be at your company, so that everyone has the similar foundation. So they should understand, what is the mission? What are we trying? What is this company about? Who are our customers? See demos. Sit in. Everyone should sit in on a demo whenever possible. With a new potential customer, sit in on a customer success call, so that we have a shared foundation. And then each manager of those departments should have an onboarding plan for the specific hires. But that tactical stuff is something I would make sure the hiring manager has a plan for. Along with, if you have a head of talent and HR.
For early hires, best sources of early hires, Dustin. Like your first 10 people, say.
I might be contrarian. My best hires, some of my best hires, I won't qualify all of them. I have indexed more for IQ, EQ, but mostly desire to be a part of what you're doing rather than experience of what you're doing. I can't get over how much better it is to hire missionaries versus mercenaries. What kind of better culture you'll experience if people are just like, I want to be a part of this startup. I see where it's going. I want to be instrumental there versus I want my paycheck. I want to do my 9 to 5. And I think this is a stable company. They might on paper look fantastic, but as that high IQ, high EQ, and motivated individual starts ramping, they're going to pass those individuals very quickly.
And does quick question? Just sorry, one more, Patrick. Would it in this first 10, very early stage, does it all come down to compensation? I mean, I suppose the simple answer is no. But how? I don't know if it's simple to measure or determine this, but how much of it does come down to compensation?
I mean, those first 10 hires, and it really depends on the company. I won't give you metrics on my current company today. I'll give you it on my past company, but this was 2013, so you can escalate. We hired our first 8 people at $90,000 a year, which was cheap as shit even then. And those first 10 people were fucking awesome. They were
That was San Francisco, right?
San Francisco. And I'll give a shout out to Nate Mihalovich. He was our first non-engineering hire, and him and I spent more time. We cold called more general contractors over a 3-month period of time than I'll put against any 2 SDRs ever in the space all day long, to the point, in fact, we annoyed every single person at WeWork. We had an open seating and they allowed us to just call. So first the people at WeWork were like, okay, now you need to use the call booth. Okay, we'll use the call booth. But we'd be the first ones in the office, so we'd be in the call booth first. And then people were like, well, they're always in the call booth, because we would get in at 7 a.m. and then people would show up at 10 and like wonder why we're in the call booths already. So
wonderful.
Nate knew nothing about construction, and that guy is a friend for life, and he's gone on to start a company, and they got acquired, and yeah, he's amazing.
Perfect segue. I was going to ask you, based on your experience in our sector, AC, positive correlation, negative correlation, or just no correlation between hires that come with logo backgrounds, schools or employers, and no logo backgrounds, completely quirky?
So at Building Connected, we actually, it took until employee, no, Al was from, we were borderline 100 plus employees before we ever hired someone from an Ivy League or Stanford.
Interesting.
But I think it was also a symptom of the time. Jesse and I, we had a chip on our shoulder because every VC turned us down for a seed round. The bar was very high for us. We were 2 founders with no track record. We weren't from Google, Apple, or Facebook then. We were selling construction software, which no one was investing in then. Our business model was very contrarian. It was give away free enterprise software to create a network for an antiquated space. So trying to get VCs around it. So the bar was insanely high for us. And so then we'd see founders from Stanford, MIT, or Harvard just raise capital on absolutely terrible ideas and products. And it was like the solo mo space, social, local, mobile. And it was like, how do you connect? I don't know. One guy was pitching me. I was trying to, create value from like, I'm leaving my seats at the Warriors game at halftime and I want to sell them. I'm like, okay. That wasn't so we didn't have success even like recruiting those individuals because of our resume, and we embraced it. We said we'll be the outliers to this space, and we found value elsewhere. And it was a time when a lot of people wanted to break in, but a lot of companies wouldn't take them on, and they would just be the brightest people in the world. And
I love
it was
this.
wonderful.
Yeah. I love that.
Yeah.
That certainly
the
changed
bar was
mine.
really, really high.
Yeah.
Well, I'll tell you a story. We couldn't raise capital, so I ended up raising angel capital. Owen and Martin might know this. I mean, I raised about $250,000 just by pitching people at coffee shops. I'd go up to a random person.
I heard the episode. Yeah.
But like, even to raise our seed round, like we got turned down by 50 VCs. So what I did was I started writing VCs emails, and I would say, hey,
here is our business. Here's what we're going to go execute on. I don't want to meet with you right now. If I can execute on these, will you meet with me then? And Homebrew talks about it. I think I'm still their first cold email investment, but I don't know if they've ever gotten one like that. But that was ultimately how we raised capital.
I think it's masterful. It's absolutely masterful. Yeah. It almost sounds to me, I don't want to put words in your mouth, so correct me, but there is a confirmation bias on my end. But it almost sounds, I want to hear that in what you're saying, that there's a slight negative correlation between logos and the success of the people you hire in this industry.
In this industry.
Yeah, specific.
Maybe slightly negative.
Why did you get these IV people at the 100 number of employees?
Oh, I mean, we're just hiring and great people came through. There's great people everywhere and there's bad people everywhere. And it's your job to filter.
Patrick, what are your thoughts from your portfolio maybe, or trying to hire someone from Ivy League?
The question I was asking, or on Owen's question?
Yeah, your question.
I'm not involved with the hiring of my portfolio companies. And if I were, they would do terrible because I'm okay. But where I am involved, of course, is in judging people as, in the context of the founders and then my little small team that whatever, that is too small to even be informative for this conversation. But for the founder side, I have found a slight negative correlation to logos in your prior past. And I think it has to do, I've rationalized it for myself. I think it has to do with our sector being an apprenticeship sector. So apprenticeship sector as in, you will not stop learning in this industry. Dustin, again, I imagine you're learning every day from your customers, even after all these years that you're in this space. Correct me if that's what I'm experiencing.
I say this all the time. Anyone who thinks they know everything about construction is a fool. I actually say I'm much harsher. But when you start approaching it like you know more than the customer, I've been in pre-con a long time. My co-founder knows more about estimating than me. We have 4 estimators on our team. They know more about estimating than me. Every single customer we talk to almost universally knows more about it. I am not a practitioner of estimating anymore. Now, can I connect the dots and interpret what they're saying? Yes, I can. But you should always be learning.
Right? And so that's going to happen to you if you're a founder in this space, in my opinion, for as long as you'll be here. I think you will not stop apprenticing. And the metaphor of the apprenticeship has a second component. And that is, I think, this sector rewards rewards founders with unique experiences before you came into this sector, as long as they have given you the ability to connect with people, to have an empathy for the quirks and all these details that you need to learn, and what logo you had in your past, what career you had in your past, who you work for, whatever. Everything can be relevant and nothing can be relevant. It depends on how you're approaching it. And so that's why I have seen literally founders, second, third time founders come into this space and fail. I've seen them succeed so far. And I've seen first time founders from big logos and small logos succeed and fail. I have found absolutely no correlation between what kinds of logos you had in the past. I think it's because of this apprenticeship character.
I will say one thing I can't stand is the founders that have some obscure story that's complete bullshit on why they want to solve for construction. My uncle did this.
I built a home and it was a terrible experience.
That one has been regurgitated numerous times.
And then you became beep, beep, beep.
Just don't say it. Just say, look, we want to build a company. We explored this. Here's a problem we found. Yeah. You have no contextual understanding of the day-to-day operations.
Trying to play on emotion.
One last question, guys, for you to wrap this up. What is the true TAM of the construction industry?
It's 100 trillion.
Shall I add some context to this? So yesterday in a group chat that we were involved with, someone put a post of a LinkedIn person who had posted that the TAM of report writing globally is 4 trillion.
And just civil engineering report writing. That's
Civil
very
engineering report writing is 4 trillion.
crucial.
So I never knew that, and therefore I'm curious as to what TAM figures we should be assessing our industry by.
I think this was just dishonest and trying to I don't know, being dishonest really, because it's completely untrue. It's probably more than like 25 to 100x less than it is.
I mean, let's cut some slack, guys. I don't have to attach maliciousness when I can attach mistakes or errors to a certain behavior. I think this might have been more an AI mistake than.
That's such a lovely way to end this episode, actually.
Well,
I mean,
advice to founders that are worried about, is your TAM big enough or not? It doesn't matter. The construction industry, if you find a solution to a problem, it's going to affect a lot of people. That in and of itself allows you to grow a business, and you will be able to expand outward from that nexus you've created. And if you land with VCs that say what you're doing today is not a big enough TAM, I would encourage you to find VCs that approach approach investing from be the winner in a small space and expand outward, versus a VC that says you have to address this huge market from day one.
Amen.
That's it.
Thank you, guys. Everyone here next week. I'll stop recording.
Yes.
Ciao for now.
Bricks, Bucks, and Bytes.